So, the company that makes Activia yogurt just dropped $1 billion on Tech Bro protein sludge.
It's not sludge, Nate. Huel has insane margins. Though seeing Danone try to market meal replacements to gamers is going to be objectively hilarious.
It's a total desperation move. They're terrified.
Oh, come on, it's a brilliant demographic hedge. But if you want to talk about actual desperation, look at what Abbott just paid for Exact Sciences.
$23 billion. My inner banker is sweating at that premium. Let's look at the math. The rundown. I just love the visual of French dairy executives sitting in a Paris boardroom drinking beige sludge.
Hey, that beige sludge just got a $1 billion valuation. Danone buying Huel is honestly the most obvious Gen Z pivot I've seen all year.
It makes perfect sense. You've got a legacy food conglomerate realizing their future consumer doesn't want yogurt. They want a shaker bottle full of optimized macronutrients.
I read the press release. They actually used the phrase nutritionally complete lifestyle brand.
That's pure banker speak, for we overpaid for powdered oats.
Speaking of aggressive valuations, IBM officially closed the Confluent acquisition, $11 billion for enterprise data streaming.
I'm actually going to defend this one. The analysts are calling it necessary, and I agree. Big Blue had to do it. They need to dominate the data pipeline.
Dominate? Nate, look at their track record. They buy these high-growth tech platforms and then suffocate them under layers of legacy enterprise sales processes.
Oh, come on. Red Hat worked out.
Red Hat survived. There's a difference. Confluent needs agility, and IBM moves like a glacier. I give it 18 months before the core engineering team walks.
Spoken like a true tech cynic. Let me pivot to something you can't argue with. Thermo Fisher finally closed Clario. $8.875 billion.
I love that you included the 7.5.
I know you hate rounding.
Precision matters. That's $75 million. You don't just round away an entire mid-size yacht.
Fair enough. Okay, quick gossip. Two Harbors just abruptly terminated their cross-country mortgage acquisition. Totally walked away from $10.80 a share.
Wait, really? The termination just hit?
Cold, dead. No explanation yet, which means somebody found something absolutely radioactive in the loan book during late-stage diligence.
Oh, I'm definitely pulling those SEC filings tonight. I need to see what killed that transaction.
You do that. But right now, we need to talk about the absolute monster that just closed. Abbott Laboratories and Exact Sciences. $23 billion.
The oncology portfolio on this combined entity is staggering. It completely rewrites the diagnostics playbook.
Exactly. I want to look at how Abbott actually structured this beast to get it across the finish line. The big one. $23 billion? I don't care what multiple you're looking at. That is a massive check for Abbott to write just to own the mail-in poop testing market.
Oh, come on, Nate. You're completely missing the actual oncology pipeline here. Cologuard is the cash cow, yes. But if you read the actual investor presentation, they're buying the Precision Oncology Network.
I read the deck, Maya. It's a beautiful deck. But $23 billion? When I was pitching medtech deals, a premium like this would get you laughed out of the room unless you had a guaranteed monopoly. Exact Sciences does not have a monopoly. The liquid biopsy startups are breathing right down their necks.
Which is exactly why Abbott had to buy them now. It's a defensive moat. Exact Sciences has the brand recognition and the provider relationships. You plug that into Abbott's global distribution machine, and those liquid biopsy startups suddenly look a lot less threatening.
See, I look at this and see a classic panic buy. Abbott looked at their organic growth projections for the next 5 years, panicked, and decided to buy revenue.
Panic buy? Are you kidding me? They've been circling this space for 3 years. Look at the deal structure. It's not just a revenue grab. Abbott is fundamentally shifting from infectious disease diagnostics, which fell off a cliff post-COVID, into chronic and oncology screening. It's actually a very methodical pivot.
Methodical and expensive aren't mutually exclusive. I'm just saying $23 billion is a lot of test kits. It reminds me of the Danone news this morning.
Wait, how on earth are you connecting Abbott Labs to Danone?
Bear with me. Danone is dropping $1 billion to buy Huel. A traditional yogurt conglomerate buys a Gen Z liquid meal replacement. Abbott buys Exact Sciences. Both are legacy giants paying massive premiums to acquire very specific gastrointestinal processes.
That is the worst analogy you have ever made.
You smiled, I saw it.
I winced. There is a medical difference. But fine. Let's talk about the winners and losers here. The winner is obviously Exact Sciences shareholders. Who is the loser?
The mid-tier diagnostics companies. If you're a standalone screening tech firm today, your path to an IPO just got blocked by a new juggernaut. You either get bought by Thermo Fisher or you get crushed. Speaking of Thermo, they just closed their Clario buyout for $8.8 billion. Consolidation is everywhere.
Exactly. And it's not just happening in healthcare. If you thought Abbott was throwing around serious cash to dominate a sector, wait until you see what IBM just did in the enterprise data space.
$11 billion for Confluent. Big Blue is definitely not playing nice anymore. Voices. So the consensus on Wall Street today is that IBM is back in its predator era. I am looking at a note right now calling the $11 billion Confluent deal a, quote, necessary and aggressive move to dominate enterprise data streaming.
Aggressive? Big Blue hasn't been aggressive since the Clinton administration. They are buying growth because they have to.
$11 billion is aggressive, Maya? You do not drop that kind of cash just to tread water. Confluent gives them the actual crown jewel of data streaming. It is a brilliant play.
I'm not saying it is a bad asset. Confluent is great. But look at the premium. IBM is basically paying up to mask the fact that their legacy infrastructure business is completely flat. Necessary? Yes. Brilliant? Let me see the integration plan first.
Fair enough. But if you want to talk about reaching for growth, look at what analysts are saying about Danone scooping up Huel for $1 billion. They are calling it a massive pivot toward the Gen Z meal replacement market.
Wait, Huel? As in the beige sludge that tech bros drink so they do not have to stop coding to chew.
That is the one. That sludge is a $1 billion asset now.
That is actually hilarious. But a pivot to Gen Z? Come on. Danone sells yogurt to toddlers and baby boomers. They are not pivoting to Gen Z. They just want Huel's direct-to-consumer margins.
I think you are underestimating the strategy. Danone knows traditional grocery aisles are dead zones for growth. They are buying a lifestyle brand. It is exactly what Estee Lauder is trying to do right now with those Puig acquisition rumors. You buy the cool factor.
You cannot buy cool if you immediately crush it with corporate bureaucracy. Ask anyone who ever sold a startup to a conglomerate.
Spoken like a true cynic.
I prefer realist. And if we are talking about cold hard reality, we need to talk about what just happened in diagnostics.
Oh, you mean the $23 billion elephant in the room?
Exactly. Abbott buying. Exact Sciences changes the entire medtech board. Spill the tea.
So someone needs to explain to me how a deal that was seemingly locked up at $10.80 a share just vanishes overnight.
You mean the Two Harbors and cross-country mortgage ghosting? Because I am fascinated by this one. Usually when a deal terminates this abruptly, somebody found something absolutely radioactive in the data room.
See, my ex-banker brain says it is not the books, it is the rates. You do not buy a mortgage originator right now unless you hate yourself or your shareholders.
Oh, come on. They knew the macro environment when they signed the term sheet. You do not just wake up, look at the 10-year yield and say, oops, never mind. I am telling you, there is a broken covenant or a hidden liability buried in the footnotes here.
Agree to disagree. I think the board got cold feet and their lawyers found a convenient exit clause. But speaking of things that smell funny.
Wow. That transition was a stretch even for you.
Just let me have it. The rumor mill is on fire today saying Estee Lauder is in active talks to buy Puig.
The Spanish fragrance giant. I actually think this is brilliant. Estee has been bleeding younger buyers, and Puig owns all the cool brands right now.
Sure, but at what multiple? Estee is already fighting off activist investors. Going on a massive European shopping spree feels like a classic executive distraction play. Look over here at the shiny perfume bottle. Do not look at our shrinking margins.
It is not a distraction, it is a survival play. Speaking of survival plays, did you see Danone is dropping $1 billion on Huel?
Wait, really? The tech bro meal replacement sludge?
Exactly. Analysts are calling it a massive pivot toward the Gen Z market. Traditional food conglomerates are so terrified of irrelevance that they are literally buying powdered gruel.
A French dairy juggernaut trying to market tech gruel. I would pay to see that pitch deck.
Well, save your money because tomorrow we need to dig into the regulatory filings for that $22 billion Corebridge and Equitable tie-up.
Yep, and word is Sony is inches away from closing a $1 billion deal with TCL. We will be tracking all of it. Tomorrow's radar. I'm refreshing sec.gov at 6 a.m. tomorrow for the Corebridge and Equitable filings, $22 billion. Financial services tie-ups of this size are rare right now.
Rare because they're regulatory nightmares. You really think this sails through?
I actually do. It's a clean strategic fit. They operate in adjacent lanes.
Adjacent lanes? Nate, they're going to have overlapping footprints all over the annuity market. I guarantee you the antitrust risk factors in that filing will be a novel.
Spoken like a true skeptic. Fine. If you hate financial mega mergers, what's on your radar?
The ghost of cross-country mortgage. Two Harbors just abruptly walked away from buying them for $10.80 a share. Terminated? Done.
Wait, really? Just killed it?
Poof. I'm dying to know what they found in the due diligence basement.
Oh, I love a busted deal autopsy. That's a banker's true crime podcast right there.
Exactly. We'll be digging through the wreckage of that one tomorrow.